I wanted to get your thoughts in on what we've seen in terms of volatility, not just across equity markets, but also bond markets. In the last couple of months, the fears around inflation, the standoffs in many countries between central banks and bond markets, the outflows that we've seen of foreign money from India, not very substantial but small. But can you share your views on where you think we're headed from here?
Yeah, so I think the first thing is that the recession last year was a very different type of recession, and I think most forecasters, I think, struggled, and including us, have struggled to grasp the longer term implications of that, right? So what we saw was that if you think about CY21, in India's case would be like FY22 versus CY19, right, the pre-pandemic year, and you thought that CY20 didn't exist, how much lower should CY21 be? And I think there, just like in India's case, FY22 was first, it was cut so much that it went 2% below FY20, and now I think it's at +2, and I think it should be +7, +8. And I think that reset globally, the fact that this was not the Lehman bust, that this was just forcing people to stay behind, and then a lot of government fiscal stimulus coming through. So I think the growth rebound has been and is likely to be much faster than in earlier recessions, right, from the low levels. It may still be below where we would have been in the pre-pandemic path, but it will be faster. And I think what we have seen because of that is that bond yields have gone up. Now, that's not surprising. Pre-pandemic 10-year bond yields in the US were at 2%. Now, if you cannot expect them to stay at 0.5 if the recovery is actually faster than what you had anticipated. When something like that changes that rapidly, it creates turbulence everywhere, right? So there are fears, and at the same time, demand supply, right? So if you have the industry as well, right? So the industry is not paid to forecast, right? They are paid to produce oil, paid to produce aluminium and steel, right? And their forecasting, in many ways, is no better or worse than that of the market forecasters. So we have been caught napping. The pace of the recovery turned out to be much faster, and therefore everything came into shortage. Now what you're seeing is that so for 2-3 months it seemed as if oil could not stop, that steel would not stop, iron ore was at 180, and this was the supply chain bullwhip that we kept talking about. This is not going to last, right? Because one, there was a services to goods transition during the pandemic. As the economies open up, there will be a switch back to services, and therefore the demand for goods is going to fall. Many of the other emerging markets, because this normalization happened and their external accounts had not balanced as much and they were not attracting as much capital, say Brazil, Turkey, Russia, they've all been forced to raise rates. So suddenly the tightening is starting much before the market anticipated it. The collective imposition of, or at least reprimands being delivered by the Western world, like the US, Europe, and China, has also created uncertainty around, as we must have seen, the Hong Kong market has been very weak. So this is now bringing in new types of uncertainty into the system, and which is a good thing. It's also part of the normalization process. It was because if oil was at 60, 65 before the pandemic, for it to be, unless you thought that a lot of capacity had been destroyed, for it to actually go to 75, 80 was unlikely, right? And this is why I have never been worried about inflation being sticky. I was worried that inflation will rise because of the supply chain bullwhip, but so I think we are seeing that adjustment. That is why this volatility is happening. People are now recalibrating that this growth to value switch, has it now overdone? The dollar weakness, which had become so consensus that I was worried that it would swing the other way. It has started to swing the other way. The dollar is actually strengthened. And this is expected to be shorter term because the US somehow seems to be addicted to fiscal deficits now. And so removing that addiction or reducing that addiction is perhaps the next step, but we'll have to see that. So there are, I think, uncertainties. That's why there is a market. But so this volatility is, I think, an adjustment process, right? So the straight line recovery that people expected is no longer going to be straight line. Central banks will take decisions. Government geopolitics will keep changing. And now you have to start pricing that in.
Okay, you used a word that I wanted to use as well, which is adjustment, right? It seems to be like the markets are adjusting, like you said, with the pace of recovery. One quick follow-up question specific to India. I think in India, what we've been seeing play out in the bond market is more to do with, the borrowing program. I don't know whether inflation expectations are very sticky here. How do you view that? How do you view very quickly the small amounts of foreign outflows that we've seen here in India? And also, Neelkanth, let's not forget, we do seem to be in what looks like the second or third wave, depending on how you count it, in terms of increasing number of cases. Now, very different from last year because there are no overall lockdowns, shutdowns, and things like that. But does that change your estimation of the pace of the recovery?
Actually, you answered the question that the impact of the pandemic. I mean, and I do not want to dismiss the risks from a very sharp surge, right? I mean, so you must have seen the Punjab study yesterday that 80% of the cases were the UK variant, which spreads very rapidly. It is not more virulent in the sense that it doesn't, the fatality rates are not higher, but the pace at which it spreads, it actually puts pressure and perhaps ends up killing more people. So this is not just another flu, but at the same time, the fact is that most of the vulnerable people have been vaccinated. The super spreaders in, say, public officials, essential workers, medical staff, they have been vaccinated. The case fatality rate even now is 0.5%, despite the number of deaths picking up. And infection fatality rate. Now, the infection to case ratio, which was at 25-30 times earlier, based on seroprevalence studies, because the identified cases are a fraction of the total cases, right? Because there are so many asymptomatic infections. So that may be even 10. Say that may have fallen because the testing is still at 1 million a day. But even if it is 10 times, right? So infection to case ratio is 10. So the infection fatality rate is still 0.05%. So for the right reasons, I think the administrators are going to be a lot more careful about imposing activity restrictions because the cost of that has been seen. And as many regulators have, administrators have said that, the first lockdown was essential because they didn't know what we were dealing with. Now we kind of know what we're dealing with. And there are some tools available to us, which is why the 45 plus, and I'm very excited now, has been opened up for vaccination. Yeah. So we are disclosing our ages now. So the point is that this is, so the economic impact of that, and in fact, the people's reaction to that. Like, look at rural areas, right? I mean, in my village, people now yawn when you tell them about COVID, right? So the point is, the economic response comes from either administrative controls or people's fear. Both, I think, are now much lower. And therefore, it can, perhaps if, that 108 that I was talking about, that, if FY22 in real terms was 100, FY20 was 100, we 108. Maybe it's 107.5 now or 107, right? But it is still far higher than what consensus is at and what I think market is pricing in. So I'm quite okay with that. There was the question on the Indian bond market. Now, I think
bond and equities, I think, because I think a lot of viewers will want to know what your outlook is from here on.
Sure. So on the bonds, I must say that reading too much from the Indian bond market is unwise because it is a very distorted market. There is a structural shortage of bond demand. So I've been saying this now, and it makes me a bit unpopular with the bond traders. But the point is, the bond price setting is actually done by people who hold less than 1% of outstanding bonds, right? So the most vocal ones are the private bank treasury guys and the mutual fund guys. And naturally, the bond buyers will have a bias for higher yields. It's a given. The problem has been that as you cut the SLR, right, over the last 15 years, there is no structural buyers that has actually, the structural buyer that has come in. So till the time that we get included in the bond indices, it is going to be like this. Because see, if you think about actual bond demand supply, this year, the government announced some 80,000 crores of extra borrowing, right? Yeah. Now you look at the corporate tax collection, the data that, some news reports talked about, that it's actually going to be 1 lakh crores more than what the government had put in the revised estimates. So that cancels it out, right? So no extra issuance of bonds. Are the yields going back to 5.9? They're not, because there is price setting happening. So taking too much of fundamental information from the Indian bond market is something that I would refrain from, because it is a lot more liquid than it used to be, but it is still not. There are not enough. There's not enough diversity of action. There's not enough diversity of analysis of perspectives that price that, and so therefore prices are not as informative as I would like them to be. So therefore, I don't want to read too much into that. On the equity side, see at a nifty levels, so when we put out, and I used to say in December in our outlook that we will expect double-digit returns. Those came by end of January. So after that, it's very hard to keep saying there were no more double-digit returns, right? So what we can advise is that I think the growth proxies, banks and industrials. So our advice is mostly on the sector preference. So so it is more about banks and industrials than on just buying high-priced excessive PE stocks, which may not see that much of a growth surprise. So it's not a growth versus value thing that people like to simplify it to, because in industrials there are stocks valued at 60 times earnings that we are overweight on, right? Because that's where the earnings can surprise positively.